In this video, I'll be explaining how the fiat banking system works. In my last two videos, I've been going through the ancient and then modern banking systems. And actually, I found that the fiat banking system is so abstract and almost kind of intangible in many of its aspects that the best way of getting my head around it is to first understand the earlier banking systems, because we actually got from the ancient banking systems to the current system through a number of increments. Now, I've covered these in detail in my previous two videos, but I'll just briefly summarize these different steps that got us to the fiat banking system. So, in ancient banking systems, like, say, the ancient Babylonians, actually the vast majority of people never really touched money because most people back then were essentially just slaves. And all the money that was circulating in these much smaller economies was commodity money. With the ancient Babylonians, it was actually barley that was used as commodity money, or then later gold, measured by weight. But with other ancient banking systems, it was, which is easier to think about, it was gold or silver coins that were used as commodity money. So this money had real value within itself, and it's kind of easy to understand concept. There was actually some demand deposit money. By the way, in my previous videos, I was calling this money of account, but I think a better phrase is a better definition is demand deposit money. So there was a small amount of demand deposit money, but this was stored, say, on clay tablets and was a very fractional component of the overall money supply. So then if we move forward to Renaissance Italy, there are more of the kind of working class or normal people actually starting to use money now by this time. Less of the population were essentially agricultural slaves, but the majority of the money swilling around was still commodity money. It was gold coins. However, what had happened by now was that you had a merchant banking class. So you actually had merchant banks which were trading with each other, and because they didn't want their gold to be stolen when transiting different city states, they used these bills of exchange. So these bills of exchange were representative money. So now the economy is mostly commodity money, gold coins changing hands. But there's now actually representative money included in the money supply, plus demand deposit money becoming larger because now they've got ledger books and double entry bookkeeping, enabling more of the economy to be composed of debts recorded on these paper ledgers. So then the next step forward was the 15th century goldsmiths in London and Amsterdam. These goldsmiths started issuing promissory notes, which is representative money, but a little bit different to the Italian bills of exchange. These notes were redeemable for gold coin, and these goldsmiths had started issuing them, and people started then exchanging these promissory notes because it was more convenient than exchanging the commodity money, the gold coins that were circulating. So we arrived at this situation where we had fractional reserve banking, where the individual goldsmiths were lending out in much more money than they actually had to be redeemed in their vaults. And this created a larger economy with more paper ledger money or demand deposit money and more representative money in terms of these promissory notes, but still commodity money in the form of gold coins and silver coins was still circulating, and this was still quite a significant part of the economy. So then we move forward to the Bank of England, and this is essentially the creation of modern banking. Now, by now, these goldsmiths had turned into specialized banks, and there was a lot more promissory notes being entering the circulation, a lot more money being lent. So demand deposit money recorded at these banks' ledgers and representative money in circulation in the form of these promissory notes. But the majority of the economy is actually still gold and silver coins changing hands. The innovation here was that the Bank of England started issuing gilts. Gilts are the English word for bonds, but by raising gilts or bonds, the Bank of England was able to raise money for the UK government, or at the time the King. And this actually stabilizes the currency. Every subject of the King had to pay taxes and had to use the legal tender of the land, which was measured in pounds sterling. The gold coins they used had to be the ones with the King's head on them. To be the legal tender had to be pounds sterling. But also these promissory notes, which were going in increasing circulation, yes, they were redeemable for gold. They also had the value on them of pound sterling. The ability to raise gilts, it enabled the government to run at a fiscal deficit. So it could raise debt to do things like raise armies and respond to crisis. And strangely, in doing that, even though it created more debt, people wanted to buy this debt because you got a nice interest rate for it, and people had confidence that the king would always be able to raise taxes in the future. So this confidence in England being able to raise taxes in the future, and the fact that everyone has to use the pound sterling as legal tender, this gave people confidence that they could use these promissory notes rather than gold coins of the same value. And so even though they were pieces of paper based on a fractional reserve system, there was enough confidence for this system to flourish. And then we have more representative money and more demand deposit money in the system. At the time of the introduction of the Bank of England, it's arguable that we still had a fractional reserve system. But then by the time we get to 1930, this was the last moment at which we had representative money, where we had the gold standards. The promissory notes were exchangeable for gold in theory. But actually, between the 18th century and 1930, as time went on, we had the agricultural revolution and the industrial revolution, and people used more and more of the promissory notes until we got to a point where there isn't any commodity money left in circulation. By the time we get to 1930, all the money in circulation is representative money. And by now, actually, the majority of the money supply is in the form of debt recorded on the ledgers of the banks. In other words, demand deposit money. Now, it's hard to define at what moment fractional reserve banking finished, and we got to this system here where there's essentially no reserve banking, because the amount of money in the money supply far exceeds the actual gold that's stored to replace it. And actually, the majority of the money supply now is actually demand deposit money. So it makes the idea of fractional reserve banking almost kind of irrelevant by now. It's hard to ascribe at what moment fractional reserve banking ceases, but we get to this point but we go along this transition to 1930, where although in theory we have a gold standard and every note could be exchanged for gold, in reality that concept is completely ridiculous. The money supply now is dominated by demand deposit money, money that banks have lent people, deposit accounts stored on the ledgers of banks. And people have confidence in this representative money because it's denominated in pound sterling, the legal tender for the United Kingdom. And the United Kingdom at this time was the world global superpower, and other countries and banks and insurance brokers and things, they wanted to buy gilt still because they had confidence that the UK government would be able to continually raise taxes. And so this is how we got to this situation in 1930, where there's virtually no commodity money anymore. It's all the cash is representative money, and the actual majority of the economy is now actually numbers stored on the ledger books. In other words, demand deposit money. And then in 1931, the UK goes off the gold standard and we become a fully fiat currency. All the cash circulating around isn't even representative money anymore. It's now fiat money. And over time, if you go from 1931 to 2024, it's still a fiat system, but the difference is that the money supply is even larger. The economy is way larger than it was in 1931. And what's happened is fiat money is now actually a tiny sliver of the total money supply. Most of the money supply exists in terms of debt and in the form of demand deposit money. In other words, debt stored on the bankers' ledgers. And now, of course, this money is stored on computer databases. And in fact, most of everyone's transactions now aren't even with cash. The cash form of fiat money is now you beep your phone, or you use your plastic credit card, or you use your chip and pin debit card to do transactions which are direct transactions using demand deposit money. We're not even using cash anymore. So that explains how we've got to the current fiat banking system. And pivotal to the fiat banking system, the fact that all citizens and legal entities within the state must pay tax, and they have to transact in legal tender of the government, which in the case of the UK is the pound sterling. And this is because the government in any state has a monopoly on violence. Only the government's allowed to use force to force you to pay taxes and force you to transact in legal tender. So everyone in that country has to use the pound sterling or the legal tender in that country. Now, the government always spends more money than it collects in taxes. Now, the government always spends more money than it collects in taxes, so we have a fiscal deficit. And in fact, by and large, ever since the creation of the Bank of England, the UK governments have run at a perpetual fiscal deficit, as is the case with nearly all governments worldwide, as is the case with almost all governments worldwide with the current fiat system. And the UK fiscal deficit currently stands at about 121 billion, or 2% of GDP per year. We can pay for this fiscal deficit by issuing government bonds. There's always other governments who want foreign exchange reserves, insurers and pension funds who want to buy bonds because they want to get that interest, and they have confidence that they'll get all their money back when the bonds expire, because they have confidence in the government being able to collect taxes in the future. Now, according to the economic prospects of the country in the future and confidence in its ability to raise taxes in the future, the government can offer higher or lower interest on the gilts or government bonds that it issues. And then this creates this yield curve concept where government bonds at different maturities have a different yield. And the overall percentage of this obviously varies depending on how well any particular country is doing relative to the other countries and the other currencies in the world. And that's how quantitative easing works, which is a monetary policy where the central bank essentially creates money out of thin air. It just creates a debt on its balance sheet, an example of demand deposit money, and it uses it to buy government bonds. And when it does this, because that then creates a demand in government bonds, it lowers the rate. And at lower government bond rates, the financial institutions tend to then lend more money. So that's how they can stimulate the economy that way. Moving back to the captive audience of all the citizens and legal entities within a country, the majority of the money supply, which, as I say, is now demand deposit money, the majority of that is actually created by debt or by the banks lending money to people because they want a mortgage to get a house, they want to use their credit card to go on splendid holidays, and they want to borrow money so they can get a new Tesla or some new fancy car on finance deals. So our modern materialistically obsessed society is very keen to getting debt with the banks, and this is how the economy continually expands. Now, if two individuals interact with the same bank, then obviously it's easy for that individual bank to switch the numbers around on their database. However, if two individuals are with a different bank, then the banks have to coordinate with each other to affect that transaction. And at the end of each day, there might be differences between the amount of money at each bank that need to be addressed. And so this is done by overnight or interbank lending. And actually, the banks store their bank reserves at the central bank. And it's actually the central bank that affects this overnight lending between the banks to cover any little shortfalls there. That's what this overnight or interbank lending rate is, which is the interest rate that everyone talks about that the governor of the Bank of England sets. That is another way of how through monetary policy the central banks can help control the economy, because when they have lower interest rates, that encourages the banks to lend more money. And as we've seen, the entire economy is dominated by debt. So by lending more money, that helps stimulate the economy. So here, when I look at this pie chart of money supply in the UK, you see that actually we see, as I've already shown, that the fiat money in terms of banknotes is only a tiny fraction. It's only 5% of the total money supply is actually cash changing hands. The vast majority of the money supply is demand deposit money and is essentially just numbers stored or records of debt stored on computerized bank ledgers. 56% of it is retail deposits. So this is things like the money that people owe because they've got a mortgage or on their credit card, but it's also people's savings which are stored at the bank, in which case the bank actually owes you the money, but it's still a debt. And it's actually now mostly all digital. Then actually a lot less, 90% is wholesale deposits. And these are deposits not really owned by individuals but so much, but larger deposits owned by financial institutions and businesses. And then only 20% of the money supply is in the form of bank reserves. So each bank has to, under government regulation, have a particular reserve requirement. And as we can see, that's 20% of the overall money supply. And this is actually stored at the central bank. It's not stored by the banks themselves, even though it's their money. It's stored by the central bank on the actual central bank computer ledger. The systems used for this are called the real-time gross settlement system. And so this system is operated by all the banks to affect all these day-to-day transactions that we do on our debit cards at Starbucks and stuff. It's actually mediated using what are called payment service operators, but then the final settlement agent for all this is actually the Bank of England. So although we have this veneer of it being all free and privatized using these payment service operators, in reality actually it's all controlled by the Bank of England. So just as the entire financial system was centralized by the king back in these times, with his head actually stamped on the gold coin you had to use as legal tender, the digital financial system is completely centralized by the central bank. And on top of the real-time gross settlement system, we also have the CHAP system. And this is for wholesale payments between banks and large financial institutions and big businesses. And also, actually, there's a special case of if you buy a house, that transaction is managed using the CHAP system. Now, interestingly, the CHAP system before the financial crisis used to be mediated by the banks. But ever since the financial crisis, this is now directly controlled by the centralized Bank of England. So the vast majority of the fiat banking system is based on debt. The economy grows by banks creating more debt to lend people money so that they can spend beyond their means on lavish holidays and owning a house they can't afford. This fiat money has no tangible value, but everyone within a country is forced to use it and is forced to pay taxes because the government has a monopoly in violence. But because people have confidence that the government's always going to be able to enforce this legal tender and is always going to be able to force people to pay taxes, the legal tender maintains its value. Now, just to touch on money supply, and we have the differentiation between public money and private money. Now, the first thing is the notes and coins in terms of banknotes. They're only 5% of the total money supply anyway. But those that are in circulation are considered to be public money, and those still in the bank machines and the ATMs are considered to be private money. However, of course, the actual physical cash is now almost an irrelevance to the overall money supply. The public money consists mostly of the bank reserves held at the central bank. So these are the bank reserves which actually belong to the private banks, but ironically enough are considered public money because they're stored by the Bank of England, where the actual overnight interbank lending takes place, because that's controlled by the central bank. So then actually most of the money in the money supply is private money, which is mainly retail bank deposits and wholesale bank deposits. See the relative sizes down here, which I've put up against the public money, the reserve deposits. So the vast majority of the money supply is these retail deposits, which is where individuals, they owe the bank money because they've got a mortgage on a house or on their credit card, and also just their normal bank balances, which is where actually the bank owes you the money. And then the wholesale deposits being balances owned by legal entities and large financial institutions, which are also stored digitally as records of debt on computer ledgers. So, of course, according to the UK definition, this public money is known as M0, or known as the monetary base, and the retail bank deposits, wholesale bank deposits, and notes and coins held by retail banks is known as M4. Here we see the comparative difference where the majority of the money supply is private money. Now I've placed here the gold reserves and the foreign exchange reserves of the UK, so you can see how they compare with the reserve deposits. And you can see down here the fiscal deficit as it compares with our current gold reserves and FX reserves and the overall government debt. What's interesting though is when you look at the GDP of the country, it's only actually a small fraction of the amount of taxes that are collected, or the amount of money that the government spends. That actually quite surprised me. So, like I've said, because all citizens in the country must pay taxes and they have to transact in the legal tender of that country, because the government has a monopoly on violence, only the government can take you to court for not paying your tax or not using legal tender. Because of this, the fact that everyone in the country is transacting and saving using the legal tender of that country, every country has a currency which has a strength which can be measured against the all of the other currencies in the world, and there's a international market for people buying each other's currencies for use as foreign exchange reserves and other reasons. And so the value of each country's currency in the modern fiat system is based on the expected strength of each currency versus other currencies. And obviously, coming into that is the assessment of, what is the fiscal deficit, what is the government debt, what's the GDP, and how much taxes do we expect the government to be able to collect in the future. So the expected economic strength of each country and its ability to collect taxes in the future, and its economic growth and its debt profile, this is how the currencies of each country in the world are stacked up and valued against each other. And every country in the world is using a fiat system. So going back to the yield curve, this is what actually makes bonds, gilt issuance and yield curves probably one of the lesser talked about, but actually most important aspects of the entire economy. And I'm here on the website World Government Bonds. Interesting to see the advert here. And as you can see, for example, the UK, when it's issuing gilts, it has to pay a 3.85% 10-year yield on that at the moment. Whereas in a relatively strong country like Switzerland, on their 10-year yields for their debt, they only have to pay a 0.4%. And then if you look at, say, a basket case, like, for example, Venezuela, they're currently having to pay 47% yield on their debt at 10 years. So within the fiat banking system of each country, we have a captive audience of citizens and legal entities who have to transact in that currency, but confidence in the ability of the government to raise taxes in the future enables the governments to issue bonds. And so then stepping up a level, when you get to the global fiat banking system, you have all the different countries of the world we're all in competition with each other according to our relative economic strengths. Our currencies are worth more or less based on these factors. You look in 1902, when the British Empire was the global superpower. Back then, actually 59.5% of the world's foreign exchange reserves were in pound sterling. Whereas now, where the US is the world global superpower, most of the current foreign exchange reserves are stored in US dollars. And here we can see, following the decline of the UK and the transition to the US as the global superpower and king really of the global fiat banking system, we can see how the pound sterling has depreciated against the US dollar considerably in this time period. When we look at the world GDP growth over the last 2 millennia, it really is a staggering chart. And here in this chart, we focus on just the US since the year 1900. The systems of money that we used in the past, I don't think would be able to cope with the size of the economy as it currently is. And over time, as through technology and the exploitation of fossil fuels, the world economy has grown and grown and grown and multiplied. The banking system has incrementally evolved in order to keep up with that, creating the fiat banking system, which is now in operation. So my main takeaways from looking at the fiat banking system are, I can see how, as technology and the exploitation of fossil fuels progressed throughout history, the economy got larger and larger, and the banking adapted to cope with that. So we arrive at the current fiat banking system, where only actually 5% of money supply is people transacting in banknotes. These are essentially worthless pieces of paper, but nominated value in that they have the currency of the country printed on them. Then the majority, 95% of the money supply, isn't even cash. It's debt stored on computer ledgers by the banks. The vast majority of new economic growth is generated by banks creating more debt by lending people money to get their mortgages and splash their credit cards on holidays. But the fiat banking system works because even though fiat money has no tangible value, it has immense psychological value, because every individual and every legal entity within a state has no choice but to transact using the legal tender, and has no choice but to pay taxes. And backed up by the strength of modern society and the technology enforcing it, as long as there's confidence in the government being able to raise taxes in the future using government bonds, the fiat banking system remains fairly robust. strengthened even more by the fact that all of the other governments are operating fiat banking systems as well, creating this globalized network effect where the relative power of different nation states can be measured by how much other countries covet their currency for foreign exchange reserves. So that completes my investigation into the fiat banking system. I found this research extremely enlightening, and I hope you found it useful too. I do videos like this one just for fun as a hobby. It's for entertainment purposes only. Always consult a qualified financial advisor before making any investment decision.